So after a subdued recovery for most of 2025, we think the New Zealand economy is well set to turn the corner entering into 2026 and potentially early 2027. The Reserve Bank has delivered the OCR into stimulatory territory, which should be a positive for growth conditions over the next 12 months. Inflationary pressures are expected to ease as food price inflation comes down and significant spare capacity in the New Zealand economy continues to filter through. And finally, the labour market is starting to show some strong signs of stabilization, pointing that the worst might be behind us. And all of these factors combined are painting a much more optimistic picture for the New Zealand outlook over the next couple of years and setting us up for a really strong cyclical rebound. Right, so when we talk about the path to recovery for the New Zealand's economy and the growth outlook, there's basically four key engines that drive cyclical growth in the New Zealand economy. Firstly, primary sector exports. Now, there's no doubt that the primary sector has done really well over 2025 because of higher commodity prices as well as a weaker New Zealand dollar. And we expect this trend to continue. With elevated commodity prices and a stronger starting point for rural incomes, we expect that to trickle down to rural spending and employment. Add to that the New Zealand government's investment boost scheme that's designed to bring forward investment decisions, and that should prop up farm investment. And all of these factors combined, we expect the primary sector to be a major contributor to growth over 2026 and early 2027. Now, the second key driver of growth is arrivals or net migration. Now, net migration has been a sad story for most of 2025 as New Zealand's labour market's been loose. But we're starting to see some strong signs of stabilization in the New Zealand labour market alongside some pickup in the more higher frequency activity indicators like job ads. Couple that with the New Zealand government's net migration restriction easing, and we expect all of these factors combined to drive net migration higher over the next couple of years. The third key engine for growth in the New Zealand economy is tourism, and tourism is New Zealand's largest services export, and it was one of the worst hit sectors during the COVID pandemic. But where we are right now, tourism's almost recovered back to its pre-pandemic levels, and it's tracking close to 2019 numbers. And we expect that trend to continue as the tourism marketing spending ramp-up initiatives by the New Zealand government, coupled with a weaker New Zealand dollar, attract more tourists towards New Zealand as it makes New Zealand a cheaper destination to travel to. And finally, not to forget, housing. Housing wealth effect is a really important driver of consumption in New Zealand, and consumption is about 2/3 of the entire GDP basket. While housing's been muted through most of 2025, we're starting to see some signs that suggest that these dynamics are about to turn. You've got mortgage rates coming down, which should improve housing affordability. And we've also started to see some signs of increased turnover and lending in the housing market. And all of these factors combined are setting us up for a more optimistic outlook for housing over 2026 and early 2027. And all of these four factors combined comprise the path to New Zealand's recovery and are starting to accelerate, setting us up for a really strong couple of years. So interest rates across the curve have come down a lot, and that's been driven by the Reserve Bank's monetary policy easing cycle. And looking ahead, we expect the Reserve Bank to conclude its easing cycle by the end of this year and keep OCR in stimulatory territory for some time. But it's interesting to note that once the growth recovery starts to happen and the output gap narrows, policy should adjust more gradually towards neutral settings. Historically, cash rates remain stable for about 12 to 14 months after an easing cycle, and that would put the onus of the first rate hike at some point in early 2027. But financial markets, being forward-looking, tend to price these expectations in advance by about 3 to 6 months. So we might see interest rates at the front end of the curve, the 1-year and 2-year rates, start going up by about late 2026. Now, given our relatively optimistic outlook on growth, we expect growth conditions to surprise on the upside in the economy over 2026, and that could bring this timeline forward. In other words, if growth conditions start to surprise on the upside, the Reserve Bank and the financial markets might need to start pricing in those potential and eventual rate hike expectations forward than most market participants are currently assuming.